Welcome to this episode of OJ Samuel's Accounting and Reporting. In this episode, we'll be dealing with certain disclosures, and this is very key. So the title for this episode is Disclosure of New Standards and Amendments to Existing Standards in Financial Statements. Disclosure of New Standards and Amendments to Existing Standards in Financial Statements. That is the title of this episode, and that is the focus. So the question is, when new IFRS accounting standards are issued, or when amendments are made to existing IFRS accounting standards, what is the reporting entity or preparers of financial statements required to do under such circumstance? In line with the provision of IAS 8, there is a clarification that the prescription of what such entity or preparers are required to do under such circumstance. So we'll be focusing on IAS 8, but we need to clarify, as at the time of this production, IAS 8 is titled Accounting Policies, Changes in Accounting Estimates and Errors. Accounting Policies, Changes in Accounting Estimates and Errors. That is the title of IAS 8 as at the time of the production of this video. The International Accounting Standard Board issued a new standard titled IFRS 18, which is Presentation and Disclosure in Financial Statements. This standard becomes mandatorily applicable in 2027 from January 1. Mandatorily applicable from January 1, 2027. The issuance of IFRS 18, Presentation and Disclosure in Financial Statements, creates a massive consequential amendment to IAS 8, leading to the retitling of IAS 8 to be known as Basis of Preparation of Financial Statements. So the consequentially amended IAS 8 that will be applied together or alongside IFRS 18 is titled Basis of Preparation of Financial Statements. So for an entity that is not yet voluntarily applying IFRS 18, or that is yet to apply IFRS 18, the version of IAS 8 is Accounting Policies, Changes in Accounting Estimates and Errors. But for those entities that are applying IFRS 18, they are bound to apply concurrently the retitled IAS 8. So for such entities, the title of IAS 8 is Basis of Preparation of Financial Statements. So we need to clarify the context so that when we refer to IAS 8 as accounting policies, changes in accounting estimates and errors, we know we're referring to that version that applies before the mandatory or before the voluntary application of IFRS 18 that will go alongside a retitled IAS 8. So stay with the IAS 8 that we've clarified. What is the requirement of IAS 8 concerning new standards and amendments to existing standards in the financial statement of an entity? So we'll be going straight to the provision of paragraph 28 of IAS 8 titled Accounting Policies, Changes in Accounting Estimates and Errors. So I read paragraph 28 of IAS 8. It states, when initial application, the first time, when initial application of an IFRS has an effect on the current period or any prior period, will have such an effect except that it is impracticable to determine the amount of the adjustment, or might have an effect on future periods, and it shall disclose A, the title of the IFRS. So an entity applying an IFRS accounting standard for the first time, is required to do this disclosure. So there are generally two categories of disclosure that are often mixed up by most preparers of financial statements. There is the disclosure for the initial or first-time application of an IFRS accounting standard or first-time application of amendments to existing IFRS accounting standards. So there are disclosures associated with that category. And there are another one, they are similar, but they're different. And they are disclosure of new standards and amendments to existing IFRS accounting standards that are not yet mandatorily applicable. two different focus. A group or a set or a class or a category is the disclosure required on the issue of first application of a new IFRS accounting standards and amendments to existing IFRS accounting standards. So that disclosure that is required to be made by an entity applying a standard for the first time or an amendment or a set of amendments to existing standard for the first time. That's a different disclosure from the disclosure that is required from an entity on those new standards or amendment to existing standard that are not yet mandatorily applicable. So most preparers lump or mix this up, but there are two different categories, distinct categories of disclosure that should be made. So when an entity is applying an IFRS accounting standard for the first time, or applying a collection of IFRS accounting standards for the first time, or one or a collection of amendments to existing IFRS accounting standards for the first time, that entity is required to do certain disclosure. That is in line with the paragraph 28 of IAS 8, accounting policies, changes in accounting estimates and error. On the other hand, where there are new IFRS accounting standards or amendments to existing IFRS accounting standards that are not yet mandatorily applicable, they are totally futuristic. Apart from an entity applying them voluntarily, right, as an early adopter, so an entity may apply them. But ordinarily, these are standards or amendments to existing standards that are not yet mandatorily applicable. So there's a disclosure required. That disclosure or those disclosures is in line with paragraph 30 of IAS 8. So paragraph 28 deals with those new standards and amendment to existing standard that an entity is applying initially or for the first time. The set of disclosures required are dealt with by paragraph 28. But for those set of standards that are applicable, that are not yet mandatorily applicable, and amendment to existing standard that are not yet mandatorily applicable, they are covered by paragraph 30 of IAS 8. So we're starting with those requirements. What are those things required to be disclosed when an entity applies an IFRS accounting standard or a collection of IFRS accounting standards and amendments to existing standard for the first time? That is what we are reading in paragraph 28. Number one, the standard paragraph 20 requires the entity or preparer to disclose the title of the IFRS. What is the IFRS that is being applied for the first time? What is the title? In year 2024, when this video is being produced, a new standard, has been issued, and that standard is applicable immediately. That standard is IFRS 19. IFRS 19, subsidiaries without public accountability disclosures. IFRS 19, titled Subsidiaries Without Public Accountability Disclosures. So in the 2024 accounting period or cycle, when an entity applies that standard, it is required to disclose the title that this standard, title this, is being applied or has been applied for the first time, or the initial application of that standard in the current reporting year 2024. So the title of the standard, that's the first requirement, A, under paragraph 28. B, when applicable, that the change in accounting policy is made in accordance with its transitional provisions. So an entity is going to disclose that the change in the application, right, or the change in accounting policy is in accordance with the transitional provision of that standard. So that needs to be disclosed by the entity for specificity, for that clarity, that on point knowledge that the transitional provisions are in line or are stipulated in the accounting policy that has been applied. That is number B. C, the nature of the change in accounting policy. What is the nature of the change in accounting policy? For example, what is the nature of the change? If an entity decides to early adopt IFRS 18, IFRS 18 is titled Presentation and Disclosure in Financial Statements. IFRS 18, Presentation and Disclosure in Financial Statements. That standard brings a change to the outlook or form of the content of a typical statement of profit and loss and other comprehensive income. That standard prescribes the presentation or outlining of income and expense according to 5 categorization within a profit or loss section: the operating category, the investing category, the financing category, the income taxes category, and then the discontinued operation category, all within the profit or loss section of the statement of profit or loss. Therefore, if an entity has decided to voluntarily or to early adopt IFRS 17, then it is going to disclose the nature of the change in that accounting policy. What is the nature? So in this case, then you're going to contrast that under IAS 1, this is the way, or these are the ways that income and expense items within profit and loss are presented. IFRS 18 prescribes a 5 categorization of income and expenses under the following category. So these are some of the wording that clarify the nature of the change in accounting policy for presentation of income and expense items within the profit or loss section of the statement of profit or loss and other comprehensive income. That's an example of the nature of the change in accounting policy. That's number C. Number D, paragraph 28 requires that for that initial application of a new standard, that the entity, when applicable, discloses a description of the transitional provision. A description of the transitional provision. Every standard has guide as to how it is to be transited or how it's going to be applied for the first time. Those are the transitional provision. For example, IFRS 18 has an Appendix C. Appendix C deals with the transitional provision, the effective date, and the transitional provision, meaning how the first-time application or the initial application is to be dealt with or to be proceeded with. Therefore, subparagraph D or paragraph 20 requires a description of the transitional provision. What is the transitional provision, or what are the transitional provision contained in the new standard that is being applied for the first time? That disclosure is needed. Number E, when applicable, the transitional provision that might have an effect on future periods. Are that specific transitional provision that will have a future effect? Future effects are there provisions in those transitional provisions? Such should be disclosed also in the financial statement with respect to the new IFRS accounting standard being applied for the first time, or to amendments to the existing IFRS accounting standards that have been applied for the first time. That is provision of paragraph 28E. We'll go to paragraph 28F. For the current period and each prior period presented, to the extent practicable, the amount of the adjustments, 1, for each financial statement line item affected, and 2, if IAS 33 earnings per share applies to the entity for basic and diluted earnings per share. I repeat paragraph F. It says, for the current period and for the prior period presented, to the extent practicable, the disclosure of the amount of the adjustments, 1, for each financial statement line item affected, and 2, if IAS earnings per share applies to the entity, the basic and diluted earnings per share. The application of a new standard or application of amendment to the standard may affect specific line items in the financial statement. So this provision of paragraph 28 require an entity to disclose the amount of the adjustment made to that line item that is affected. Under IFRS 18, for example, there is a new line item referred to as profit or loss. This is subtotal or profitability or loss arising from consideration of operating of income and expense relating to the operating category. The summation or the netting of the income and expense concerning operating category, the subtotal is called operating profit or loss. Before the application of IFRS 18, if an equivalent, a comparable, or an analogous line item previously given a given name or amount was presented in a prior year, by applying IFRS 18, which is applied retrospectively, now that subtotal will have changed based on the grouping of income and expense according to the operating category first. Whereas under IAS 1, certain income flowing from investments, certain income maybe even flowing from financing activity, certain income of other nature might have been included in arriving at other income under IAS 1. For example, but under IFRS 18, such income related to investing category, financial category, are not considered in arriving at operating profit or loss. They are repositioned or reclassified to their own category in line with IFRS 18. Therefore, the line item previously arrived at using IAS 1 will reflect or produce another amount as a result of the reclassification of those line items that are no longer there in line with IFRS 18. So such line item affected by the application of IFRS 18 is required, a disclosure is required disclosing the adjustment made to arrive at the amount which differs from what it used to be for the prior year in particular. In addition, as you know, if there are measurement implications in the application of a new standard, measurement application of a new standard is going to affect either the profit or loss for the year. Affecting the profit or loss for the year will affect also the calculation, or affecting even certain profit line item will affect the calculation of earnings per share under IAS 33. While earning per share does not apply to all entities, earning per share apply only to entities that are quoted, whose equity or shares are quoted or listed, or are intending to be listed or quoted. Those are the categories of entities that are mandatorily required to apply IAS 33. So for an entity whose equity instrument is not quoted, is not listed on any market, is not even intending to file to get listed, such entities are not required, are not bound to compute and disclose basic and diluted earnings per share. They are not within the mandatory scope of IAS 33. So for those entities that are within the mandatory scope of IAS 33, the earning per share calculation, whether it is basic or diluted earning per share, will be affected when the measurement of the line item giving rise to the profitability line item is affected. Therefore, a disclosure is required of the adjustment made to that line item to arrive at the new amount or figure or the new earning per share based on the application of a new standard. That is the provision of paragraph 28, subparagraph F. We go to G. The disclosure of the amount of the adjustment relating to periods before those presented to the extent practicable. Meaning, when an entity presents financial information of earlier periods, maybe not just the comparative year, but pre-comparative year, the pre-comparative year, and in that case. So whenever the application of a new standard or amendment to a set of existing standard will affect those pre-comparative and pre-comparative period presented, the adjustments to the affected line item in those prior and pre-comparative period and pre-comparative period should also be disclosed. That is the provision of paragraph G. The degree of the amount of the adjustment relating to periods before those presented to the extent practicable. And lastly, paragraph H. If retrospective application required by paragraph 19A or B, paragraph 19A or B deals with retrospective application, right, of a new standard, meaning applying a standard to prior period as if that standard had been in application as at that prior period. That is retrospective application. I read again, paragraph H. If retrospective application required by paragraph 19A or B is impracticable for a particular prior period or for periods before those presented, the circumstance that led to the existence of that condition and a description of how and from when the change in the accounting policy has been applied. It is possible that an entity may not be able to successfully, meaningfully, realistically apply an accounting policy retrospectively. Maybe data was not kept in such a way to enable such compliance, or the accounting system was not robust enough to enable compliance, or probably it could be other administrative procedure that may hinder the ability to comply with retrospective application. That is why I would say it is impracticable. Nothing can be done to achieve retrospective application of a new accounting standard, which is the ideal when a new standard is applied, because such standards are not just applied for the current period, they are applied to the beginning of the comparative period presented alongside with the current period. That's a retrospective application. So when this is not possible, under IAS 8, an entity is required to apply the impact of the new standard from the current period going forward. You forget about that past or those past periods when it is impracticable for retrospective application to be applied. So that is not about that. So if it is impracticable and an entity reports currently in the current period and moves on, now the standard say, what are the circumstances that led to the impracticability of retrospectively applying the new IFRS accounting standard? And a description of how and from which date or from what period. Maybe an entity ordinarily presents two comparative period to a current period, and an entity could not apply retrospectively to the pre-comparative period. So the entity would have chosen to apply from the comparative period onwards into the current period and not other. So the standard say, how and from when has an entity applied that standard that it could not successfully retrospectively applied. So these are the provision of paragraph 28 of concerning new IFRS accounting standards and amendments to existing IFRS accounting standards that an entity is applying for the first time. The initial application of the standard. That is paragraph 28. Now go to paragraph 30. We deal with the new IFRS accounting standards and amendments to existing IFRS accounting standards that are not yet mandatorily applicable. So what does paragraph 30 require an entity to disclose? Because they're two different. I read paragraph 30. When an entity has not applied a new IFRS that has been issued, but that is not yet effective, the entity shall disclose, this fact. So you need to list those new IFRS accounting standards or those amendments to IFRS accounting standards that are not yet mandatorily applicable that the entity did not apply. I need to state that fact. That is paragraph 30A. And known or reasonably estimable information relevant to assessing the possible impacts that application of the new IFRS we have on the entity's financial statements in the period of initial application. This is a kind of, trying to report the quantitative impact or qualitative impact analysis or assessment if the entity were to apply those new standards that are not yet effective or that are not yet mandatorily applicable, right? It's kind of reflecting the financial impact of applying those new standards where possible. Where it is, the standard say, known or reasonably estimable information relevant, to assessing the possible impact of the application of the new IFRS. What impact will it have on the entity's financial? So this is the kind of, trying to simulate realistically in the context of the entity, in line with the provision of those new standards that have been issued but that are not yet mandatorily applicable. So paragraph 31 gives a practicalization of how this estimability can be done. It says, in complying with paragraph 30, an entity considers disclosing the title of the new IFRS. That is how you are required to disclose the title of all the new IFRS. The title of all the new IFRS or the amendment to the IFRS. B, the nature of the impending change. What will be the nature of the impending change? By applying those new standards, what is the nature? C, the date by which the application of the IFRS is required For example, in IFRS 18, will state that it will become mandatory from January 1, 2027. That is IFRS 18, presentation and disclosure in financial statements. Another example would be IAS 8, basis of preparation of financial statements. These are future standards, right? So the date should be stated. For this version of IAS 8, I've just mentioned, based on preparation of financial statement, that will also be January 1, 2027. That is the date. D, the date as at which it plans to apply the IFRS initially, if possible. Which day does the entity want to earlier adopt the standard? What is that date? Or is the entity applying it when it is mandatorily applicable? That should be stated. And also E, either one, a discussion of the impacts that initial application of the IFRS accounting standard or IFRS is expected to have on the entity financial statements, or two, if the impact is not known or reasonably estimable, a statement to that effect. So we know the standard has said in paragraph 30B that what is the reasonably estimable impacts that the application of that new standard we have if it was applied. So an entity is required to do that simulation, that quantitative and qualitative impact reporting of applying the new standard that is not yet mandatorily applicable. But the standard also gives a leeway where that cannot be achieved. The entity can just state that the impacts of this and this IFRS have not been evaluated by the entity. Simple. So there's a leeway. So paragraph 31E1 says a discussion of the impact that initial application of the IFRS is expected to have on the entity financial statement, or two, if that impact is not known or is not reasonably estimable, a statement to that effect. So these are the categories of disclosure required for new standards, new IFRS accounting standards, amendments to existing IFRS accounting standards that have been issued but are not yet effective or that are not yet mandatorily applicable. So these are the disclosures an entity should disclose or should provide in its financial statement. So two different. Those ones that deal with the initial application of the standard, initial or further application of a new standard, or initial or further application of amendments to existing IFRS accounting standard, those are separate disclosures. We've looked at them in paragraph 28. And those ones that deal with the new standards, new IFRS accounting standards, or amendment to existing IFRS accounting standards that are not yet mandatorily applicable or that have been issued but that are not yet effective. So these are the two categories. So preparers of financial statements, consultant advisors, internal auditors, external auditors, reviewers, and analysts. And entities should know these two categories and to ensure they are disclosed accordingly. Thank you for joining us in this set on disclosure of new IFRS accounting standards and amendments to existing IFRS accounting standards in financial statements. Thank you and bye for now. Watch our video, like them, share them widely within your professional network, and let's keep this job going. Bye for now.